Mark, God, it's been a long time and great to have you here with the dollar rebounding. How are you, buddy?
Good, good surviving. That's the best we could hope for.
Okay, well, in that survival, I hope you find some joy in between. We don't want to be Mad Max yet. We don't have to be yet. But what's top of mind on this dollar rebound, Mark? Is there anything that you feel it's going to be short-lived, long-lasting? What do you think?
Yeah, so I think that we had such a big dollar pullback in the last four
Oh,
months. That's September, October, November, December. Actually, the dollar bottom, excuse me, the dollar topped out end of September, early October, and we fall in the next 4 months. And I've been looking for this for the dollar to rebound. And what took the
okay.
dollar to rebound, I think, was a change in fundamentals, and that is the pendulum of market sentiment has swung from Fed funds peaking below 5% to Fed funds maybe peaking closer to 5.5%. And so I think that this has given the dollar sort of the fundamental reason to correct higher. And I think it's got some more legs, like the team spoke about. I'm thinking that still in the early stages yet. We have to really get through this 106.5 area on the euro, which I think we might today. And I think we might go down to maybe 104.5 or so. A key retracement of the big rally that the euro had off those September lows.
Okay.
I think this is fundamentally based. And but to your point, I'm not convinced it's going to last very long in the sense that I sort of share what I think it was Stephen said about the about monetary policy taking place impact with lags. And so I think that we had a horrible end to last year. We talk about you American consumers. Retail sales fell by more than 1%.
Yeah.
Well, it looks like with the revisions, yeah, fell more than 1% November and December, and the economy generally weakened. And I'm thinking that we just get this as a reprieve, but the real test will come in Q2 and Q3. And the same thing for industrial production out shortly. In November and December, manufacturing output fell by more than 1%. So we'll get the bounce back here at the start of the year. But whether it can be sustained or is a different question. I'm thinking that this is a one-quarter recovery of the economy before the real challenge in Q2 and Q3.
Okay. So the narrative will shift from rates to economic weakness, which could, have people worrying more about a recession again. I mean, now people are saying no landing. Yesterday we went from hard landing, soft landing, no landing. So the airplane is going to need some fuel if it's not going to land. Where's that going to come from? The consumer
Yeah, I
already
mean, I think you're right.
has their credit cards maxed. Their cards are maxed now, Mark.
Yeah, I mean, I think that partly also, it's not just say relatively good things happening here in the States for the economy, with the bounce back that we're seeing, both CPI stronger, retail sales stronger. We'll get a strong industrial production number shortly, but also the tail risks
China,
have been
China.
reduced in Europe.
Okay.
People were worried about a recession. They're no longer worried about a recession. It always scares me when I sort of see market sentiment psychology talking about no landing or somehow we've repealed the business cycle. I don't believe that. I think that's just part of the mentality we need to justify the risk taking that that's taking on. Still the honeymoon's going on that began the year. I think that you see this in a lot of risk taking moves, even though the U.S. stock market struggled recently. I'm looking at other markets which have recouped a good part of last year's losses. You guys are talking about Mexico. Peso's been red hot, and it's
Yeah.
not just flows into the stock market. It's a nice carry trade, and as you can see from the press coverage, foreign direct investors, that is businesses locating production, distribution in Mexico, get inside the U.S. MCA tariff walls, the domestic content, including Chinese companies. So Mexico is really an interesting story. The currency just tested 4.5-year highs yesterday. We're bouncing off that in light of the raw dollar strength here today. But I think the peso still has legs to go. I'm looking at 18. We tested that 1850 level, like you guys mentioned. I think we can go
Yeah.
back down to 18, even on that, and that would bring us back to where we were in like 2018 or so.
Okay. So a lot of people, Mark, piled into the EM trade. 2, 3 weeks ago while the dollar was under pressure. And EM has been underperforming. Is that a function of the dollar rally? And that eventually they're going to be right about outperformance in other markets outside of the U.S.?
Yeah, I think so. I think that, like the raw dollar, we've seen the correction in some of the EM. I think that, so one has to really decide really whether this is really a trend change. And a lot of the companies that I talk to these days, they basically have to put dollars into Mexico. And so they're converting dollars into pesos, pay for call centers, pay for manufacturing. And I think that will keep the peso relatively a healthy performer here. And remember the carry. I think Blake was talking about having to
Yeah,
pay the carry when he's trying to go long the dollar. I figure that the cost of hedging is almost 1% now. And a little rule of thumb here that you can do, a tool that you can have, is that I look at the forward points as a percentage of the spot price, and that tells me what it costs to hedge. And putting this in perspective for you, to hedge the Canadian dollar is about 1/4%, and to hedge the peso costs you about 1%.
yeah, big difference. I want to switch gears a little bit about and talk about the Bank of Canada was the first to raise rates. They're the first to pause. And do you think that the pause is going to be different in countries that have variable mortgages? A larger percentage of Canadian households are on variables, so their monthly cost on their mortgage has gone up dramatically compared to the U.S., where most people are locked in at 3 or so, and this interest rate increase hasn't reduced their liquidity because they're not in variables. That didn't happen in the U.S. like it did in Australia, I believe the UK, and Canada.
Yeah, I think you raise a good point. And broadly, I think it's really how the interest rate increases filter through the economy and how the U.S. household for mortgages is fairly well protected with these 30-year fixed rate mortgages. On the other hand, I'm not really convinced that the Bank of Canada is going to be able to pause for long. You saw those jobs data, just like mind-blowing strong, just like U.S. data. But put this in perspective. Canada added about 150,000 jobs in January. The U.S. economy is about 11 times bigger.
Right.
So imagine if we would have got not just a print of 500,000, but a print of over 1
5
million.
million. Yeah. Right.
And so
Yeah.
so my sense is that the market, not only has the market come around and converged with the Fed as far as expectations, but the market is now saying that the Bank of Canada's pause might last this quarter, which means that the next batch of data might not be that important, but they'll probably raise rates again in Q2. And there's just another 25 basis points. But more broadly, I think that you're right that the many of say the G10 banks, G10 central banks, are likely to pause sometime, whether it is Q2 or Q3. That end of the monetary cycle, I think we can count on this year. And I think that's going to help us in the second half of the year encourage risk taking, even if the economy weakens.
Interesting. So, okay. So if we're going to have one more capitulation move in the market, say, for example, let's take the S&P's mark, that if it's going to happen, it should happen before that, or it's not going to happen at all. That if we're going to get one more wave down in the market to challenge October lows or take them out, that it should happen before the third quarter. Is that what I'm hearing you say?
Yeah, I think that so to your point, I think that what I really like about the markets is that one way to conceive of them is they're a huge anticipatory discounting mechanism. We don't always get it right, of course, but I know that there's some people said the market has no clue where Fed funds are going to top. Of course, the market's got a clue. We know within a certain range with certain confidence, and I think that's generally true that the markets tend to lead. So we should look for the stock market to bottom before we really get the before the Fed is done. The market's going to anticipate the end of the Fed tightening, and it's getting a bit fuzzy, of course, whether it happens in Q2 or early Q3. But I think the market's now leaning much more aggressively, and so I think it leaves us vulnerable then when news does not repeat what we've seen in January, whether it's today's retail sales, the jobs data. I mean, it's hard to imagine the U.S. creating 500,000 jobs a month for the rest of this year, or for the next several months, even for the next month even. And so I think that the pendulum of market sentiment has swung, and I think this talk of no landing, it just tells me how far it's swung, and that we're going to be swinging back before the end of the quarter.
Okay. Looking at 10-year yields, Mark, we had a trend break this week, and really the inflection point was the employment number last Friday. That's when everything began to be repriced. And do you think that we have a chance to make new highs in yields over 433 in the coming months?
Yeah, my guess is we don't make new highs, even if we approach them. You know, the more aggressive the Fed is now, the more people are going to be convinced, I think, that we still headed toward a recession. That rather than this recession being an inventory cycle or something like that, I think people will begin looking for the fingerprints of the business cycle's murder at the Federal Reserve. That is to say, many people suspect that the Federal Reserve often kills expansions by over tightening. And I think the more the Fed tightens now, I think this is why the yield curve is so inverted. The market says, yeah, the Fed will raise rates in the short term, so the 2-year yield jumps, but the 10-year yield is still lagging far behind. Yield curve very steep, and even a curve that Powell has talked about, which is a 3-month rate, 18-month forward. And I know it sounds kind of complicated, but we look that money market curve is also inverted. And Powell himself has said that this is a good indicator of recession.
Okay. Don't you think it's a big problem for the Fed, where two of the biggest areas that they want to see price declines in, for example, housing, and although rates are going up, they're tightening into a housing shortage. There's not enough housing stock, makes their job that much more difficult to get the cost of housing down. And then they want to take unemployment up with a secular labor shortage. So their two biggest battlefronts, they're fighting shortages. There aren't surpluses of homes, or we'd probably see prices reflect it more dramatically. And there's a shortage of laborers after COVID that aren't coming back. So how effective and how much does the Fed have to go? Could that lead to overkill if the Fed is still targeting housing and labor?
Yeah, no, I think you're right. I think that those are the big issues. I would say though that with mortgage rates coming off almost 100 basis points in the next over the next few days into next week, we're likely to see some better data from the housing market. So housing starts likely to be weak. They're out, I think, tomorrow. Permits though could rise for the first time in a few months. And next week we're going to get existing home sales, and they have fallen every month since last January. And they're likely to pick up as well. So my sense would be something like this. Housing market sort of led into, with the higher interest rates beginning last year, housing market took the brunt of that. And we're likely to see some stability coming in. And the Federal Reserve uses, the BLS for the CPI calculation uses a dated type of backward-looking assessment of house prices, shelter costs, and I think that we'll see those begin moving lower around the middle of the year. So in some ways, what we're talking about is the first leg down in U.S. CPI was fueled by the drop in goods prices,
Right.
and this next leg will probably be carried by service prices. And for me, the key still is that the base effect, and a lot of people don't fully appreciate it, I think, that in the first half of last year, U.S. CPI rose by at an annualized rate of a bit more than 10%. And those numbers are going to drop out, including like 1.2% month over month gain we saw early last year. Those drop out. I think that CPI comes down. And I know you're talking about PPI before, and that's out tomorrow. And I think that, many of us have in our minds this pipeline effect where producer prices go up and then consumer prices go up. But the markets, and not just the financial markets, but the markets for goods is much more efficient than that. We don't have to wait for a gasoline price for the gas station to use up its old oil before it puts in the new oil, right? And so I think that to me, the real key for consumer prices is not about producer prices. Producer prices, you think about what consumers buy. Here in the US, we buy a lot of services, more services than goods, typically, leaving aside the COVID experience. And I think that's what we should be looking for inflation, is not from the PPI, but from services. And this is, of course, the big thing that Powell keeps talking about. Services, core services, excluding housing, just get the real signal. And that softened last month, rising only 0.3%. So I think we're still in a good position for inflation to fall, especially here in the first half this year. And I think that'll also take some pressure off the Federal Reserve. So the market might be overshooting here, talking about 5.5% or 6%. And instead, I think that the Fed, the December dot plot pointed at 5.25. I think that's where the Fed sticks at.
Okay, your view on U.S. dollar yen, Mark? Just like the dollar recovering, is this a bear market rally? And do you think what kind of levels are you looking at in U.S. dollar?
Yeah, last week I was talking about 133. We're through that now. For me, the key level is 135. I think someone mentioned that before as well. The 130, we haven't traded above 135 since the December surprise. That also gives us a nice retracement level. So I do think that that the Japanese Prime Minister's first choice was for continuity of policy. And when the first candidate, Amamiya, turned it down and recommended Ueda, I think that that also really speaks to continuity. And what I'd be looking for there is not a change in policy so much as just some kind of game plan of sequence. There's so many moving pieces. The Japanese extraordinary monetary policy, you got the yield curve control, you've got the center of that yield curve control at 0. So they allow it to move 50 basis points either side. They could move that. The Bank of Japan is also the last of the central banks with a negative policy rate. A small adjustment to that. They're buying a lot. I mean, as the Federal Reserve and the ECB's balance sheet shrinks, the BOJ's balance sheet is expanding even faster. And so there's a lot of room for the BOJ to tweak policy. But in general, I think that the first step is sequencing the exit strategy. Not that they're going to exit, but they just sequence it. What should come first? Should they raise rates before they stop QE? How does it play out? And so I think that in this context of rising U.S. interest rates, especially at the short end right now, I think that the dollar yen could test that 135, maybe even go a little bit above it. I'm surprised if we get to that 140 level you have on the charts.
Okay. All right. And the commodity currencies, why don't we just go with Aussie? Had a nice recovery in a pullback phase here. You have any levels in Aussie that would be attractive longs for you, Mark?
Well, yeah, so I think that we've had this first leg up, like you'd see on the charts from October, a big rally. We sort of stuck, even yesterday, we couldn't really get above that. We couldn't sustain the move above 70 cents. That's important. There's some options expiring there today. So I'd be looking for a move back to maybe it's 66, maybe it's a little bit lower. But I think that what we're going to do is correct this first big leg up that the Aussie had. More broadly, I'm looking at the 50 and 200-day moving averages of all the G10 currencies crossing except the Canadian dollar. And so I think that in my mind, that helps confirm the idea that the US dollar put in an important high last year. And so the move that I've seen up in the dollar now, I'm sort of viewing it as corrective in nature and looking at the same kind of things that, that we all talk about, Fibonacci retracements, 200-day moving average, these kind of things, just to give us some sense. It's sort of like mile markers on the highway. It's not necessarily support or resistance, but gives us some sense of the magnitude of the move that we could be expecting.
Okay. So takeaway I'm getting, Mark, is this is a bear market rally in the dollar. There could be more left, but the major trend shifted last year, and maybe the trade just got too crowded.
Yeah, I think so. And it's funny that you say that too about trade being too crowded. I've been watching what's euphemistically called non-commercials speculators in the futures market, and they still have a relatively large long euro position. And so I think it's one of the only currencies, futures, that the market has really gone long on in a significant way. And so, yeah, I think that a lot of the good news for Europe, the reduction of the tail risk, the reopening of China, priced in. What I noticed was that the index of Chinese stocks that trade in Hong Kong are now off about 10% from the
Right.
late January highs. And so I
Yes.
think that's just another sign to me that swing in the market pendulum, a lot of good news priced in, the reduction of that left-hand tail risk of bad things happening. And so I think that this has a little bit more room to play, but all it's going to do is take a weak U.S. jobs number, a softer CPI number next month, and we're back to what kind of landing we're going to have. It's going to be a landing. It's just a question of how hard.
Well, it looks like copper is on its way to declining into some type of landing. And I have to, this whole rally in copper was the reopening trade in China. So we're, testing the breakout too many times in my view. It tests it once. Okay, Dale, you missed the first entry. I'll give you another chance here. Oh, you missed the entry. I'll let you buy it here. Mr. Market is making it a little bit too convenient to trade this breakout. What do you think the implications are for copper turning south now when everyone is so bullish the China reopening?
Well, yeah, I think that this bullishness towards China really peaked while they were on holiday for their Lunar New Year. And I
Yeah,
think once they reopened, sort of reality's coming back. And
yeah,
I worry that America is getting more and more mentally on war footing. We saw with the balloons
yeah,
and that whole drama. And I just sort of think that we saw last year that Chinese population growth is shrinking. The demographics are horrible. They still have talking about over half the population living on like less than $10 a day or something like that. And so to me, China, like other threats that America partly sort of blows way out of proportion. I think, yeah, China wants to change the global economy in its favor. No, it's not going to succeed. And I think that it scares me about this war footing. We see China as the cause of all of our problems, when to me, our problems are really homegrown. I mean, we all know what the U.S. problems are, whether it's the disparity of wealth and income, whether it's the young people committing suicide, whether it's longevity in the U.S. Isn't that the ultimate measure? How long do your people live for? And
yeah,
in the U.S., it's falling, and falling more than in other industrialized countries. And so I don't think these problems have a cause in Beijing or Moscow. I think they're homegrown. And what worries me is that we keep externalizing our problems. Even with CPI, people say, well, China's reopening. That's going to cause U.S. inflation to rise. Really?
yeah,
Medical costs in the U.S. are tied to China? I don't think so.
yeah, yeah.
Shelter costs tied to China? I don't think so.
What a great point, Mark. And, something for people to keep in mind, because you have to be skeptical when Republicans and Democrats agree on something. And their and their anti-China stance is very universal in Congress. Mark, what a great interview, like usual. I encourage people to go to your Mark to Market and work with you. And I just think we're all fans here. Blake's a big fan. He has all your books, and I have an 8x10 glossy of you in my office, and just really glad that our paths crossed, and appreciate you coming and sharing your insights with our community.
Well, thanks a lot. I appreciate it. And, I really have a lot of respect for you guys. I mean, in the sense that what I've done with most of my career is basically telling sort of OPM, dealing with other people's money. But I think when I can have a lot of respect for people who have skin in the game. That's what I learned when I was my tenure at Brown Brothers Partnership Bank. People who have money in their skin in the game makes a big difference, and I can have a lot of respect for that. So good luck to everybody.
Well, you're the kind of guy that we bring your views into our assessments, which gives us more conviction about assuming risk. So thank you, Mark. My trading warrior brother, Marc Chandler, everybody.
Thank you very much.
Follow Mark at Mark Making Sense on Twitter. Go to his website, Mark Making Sense, like he did today. Adios, buddy.
Thank you. Bye-bye.
All right. So that's a wrap, everyone. Hope you enjoyed it. I love talking to Mark. I learn from him every time. And you could join the team in 18 minutes on the morning edge. And don't just count your pips, count your blessings. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.